Good morning, my YouTube family. L.A. Smith here from Kingdom Knowledge. Today, I want to talk to you about the state of our economy. And I want to do that by going over an article entitled Trump Economists Ignore This Indicator of an Epic Stock Market Crash. This video and this article is essentially a warning about what is on the horizon in the very near future. I will start by saying that I am not an economist. However, I did study economics in my undergrad studies, Bachelor's of Science in Business Administration with a concentration in management, and in my graduate studies with the Master's in Business Administration with a concentration in marketing. So, I think I know a little bit more than the average person, and that's why I'm making this video. I want to make it clear to my viewers, as clear as I can, of what is on the horizon economically, and so that you can prepare for this as best you can. A lot of us were shocked about what happened in 2007, 2008. We never saw it coming, myself included, because I wasn't really watching. If I was watching because of my education, I would have seen it. And I probably did see it to a certain degree, but I didn't know the impact it was going to have on our economy and on me personally. And the impact was pretty devastating for me. And for a lot of people. So this time, and I look at that first recession, borderline depression, that we had in 2007, 2008 as a warning for myself and most likely to a lot of other people, including, most importantly, from my perspective, God's people. So this time we should see it coming. And if we see it coming, we can prepare a little better for it. And that is the purpose of this video and going over this article. So this is Mr. Kudlow here on the left. And what is he saying? Larry Kudlow, Donald Trump's top economist, says you can ignore crashing bond yields. An inverted yield curve is often a leading indicator of a recession ahead. Not to mention a concurrent, so not only a recession ahead, but at the same time, a concurrent stock market crash. That's because investors are fleeing risk markets for a safe haven. So, if investors are fleeing risk markets for a safe haven, maybe we should be considering this as well. I mean, this is a strong indicator. And let's look at why. So, let's look at this inverted curve more and what it could mean. Inverted yield curve and why it predicts a recession. Why the yield curve is inverted now. So an inverted yield curve is when the yield on bonds with a short duration are higher. So you're making more money on bonds that you invest in on a short term than the yields on bonds that have a longer duration. It's an abnormal situation that often signals an impending recession. Because normally you get more money when you loan your money and have it tied up, or you invest your money and have it tied up for a longer period of time. But in a normal yield curve, the short-term bills yield less than the long-term bonds. Investors expect a lower return when their money is tied up for a shorter period. They require a higher yield to give them more return on a long-term investment. When a yield curve is inverted, it's because investors have little confidence in the near-term economy. They demand more yield for a short-term investment than for a long-term one. They perceive the near term as riskier than the distant future. They would prefer to buy long-term bonds and tie up their money for years even though they receive lower yields. They will only do this if they think the economy is getting worse in the near term. So that's all I think we need to know right now about the inverted yield curve to make the point that it is a very strong economic indicator. So back to the article. Long-term Treasury bond yields crashed below short-term bonds before the 2008 financial crisis that caused the Great Recession. Yields also inverted before the 2001 recession that went hand in hand with the dot-com crash. But Larry Kudlow says there's no reason to be alarmed. In a televised interview Friday, CNBC's David Faber asked about the lowest long-term bond yield market have ever seen. So the question to Kudlow was, what does the 30-year all-time low yield of 1.89% say about this economy and the perception of it? And the National Economic Council director downplayed the bond market's warning. Said, I just think in general I would be very careful to put too much emphasis on what bond rates are doing, what interest rates are doing, or even in the short run, the stock market. I think you have a lot of mood swings here, and I don't think it reflects the fundamentals. While 10-year Treasury bonds sink and the 30-year Treasury bond yield hits an all-time low, the stock market is closing out the week on a note of alarm. The Dow Jones Industrial Average ended the week with a loss after 2 consecutive days of decline, after losing 128 points Thursday with a 400-point intraday free fall. That means throughout the day, the stock markets are going up and down. The market went down as low as 400 points in that day. The Dow lost over 227 more points Friday. And Larry Kudlow calls this a mood swing. In his view, the stock market is reacting emotionally to transient short-term events that won't impair the economy's strong fundamentals. But after last year's inverted yield curve scare subsided, and as the stock market charted bold new records in recent months, Kudlow didn't say to ignore the emotions of euphoria at play and turn your attention to the fundamentals. Instead, he stoked emotions by teasing more tax cuts. So the more tax cuts is a way to manipulate the market per se, because it's going to put more money into the economy, which hopefully will have people spend more money, making people feel better about the economy, and that in and of itself tends to make the economy better. Consumer confidence is very powerful, but it's not a true indicator of what the economy or where the economy really is. So the fundamentals, stock market fundamentals are flashing red. Besides, Kudlow is cherry picking fundamentals. He's picking what he want to pick to make the story sound rosy when it really isn't. In the CNBC interview, he says America is working and there is a blue collar boom. This is a fundamentally very sound economy. He's right. Job growth remains strong and unemployment is still hovering at historic lows. But there are still other fundamental systemic risks that threaten continued economic growth and forebode a major stock market crash ahead. Ballooning deficits. This is something I always tell people when I warn them about the future of our country and our economy. Unfortunately, there are a few things out there today that can cause us problems with our economy because one, we are a global economy now, and things that happen in other countries can affect us. Agreements between other countries, um, tariffs can cause a problem, a war. But the one thing that's already here and now and facing us, looking us dead in the face, is our ballooning deficit. Chief among these is the recession level federal deficit. This is what I tell my closest friends and family. It's inevitable. The deficit is growing exponentially out of control. Peter Schiff, CEO and Chief Global Strategist for Euro Pacific Capital, says it's proof the economy is not as strong as the job numbers suggest. And another round of tax cut will make it worse. Why? Why would tax cuts make it worse? Because instead of taking the money that they're receiving right now for taxes and paying it to pay down the deficit, they're going to give it back, which means they have even less money to pay the bills. Consumer debt is another. Then there are record levels of housing and household consumer debt. So people spending money they don't have, which is juicing up the economy because interest rates are low. David Rosenberg, chief economist and strategist for Gluskin Sheff and Associates, say the economy's apparent strength is fundamentally driven by turbocharged debt. He thinks it's unsustainable and it will end miserably. The Buffett indicator. Finally, there's the Buffett indicator. Everybody knows who Warren Buffett is. The Buffett indicator, which is the total capitalization of the U.S. stock market, divided by U.S. gross domestic product. In other words, how much does the stock market say America's companies are worth relative to how much they're actually producing? It's about as fundamental as you can get. Today, it's at a record high of 158%. It was 46% when the stock market crashed in 2000 and 137% before the Great Recession toppled the stock market in 2008. The Buffett indicator and Treasury bond yields are the fundamentals. We covered both of them here, and they are not very sound. So I know that a lot of you probably still don't understand clearly what this Buffett indicator is. So let's look at it a little closer. So I basically went into Google and basically asked about the Buffett indicator and why is it important to know and what is it telling us. So this is what I learned. The U.S. stock market capitalization to GDP, as of today, the total market index is 34 billion roughly, which is, like the article said, 158.9% of the last reported GDP. Still not clear, I know. But here, this clears it up a little bit. It tells you that the ratio equals total market cap to GDP. If it's between, the number that we get after we do that division, if it's between 75% and 90%, we are at fair value for the stock market. The market and the stock prices are at a fair value. If it's between 90% and 115%, it is modestly overvalued. We're at 158.9%, y'all. So I need to click on the button for see more rows, because there's not enough rows in that particular graphic to really show us where we are with this 158. So let's see if it's in here somewhere. And there we are. So if it's greater than 115%, it's significantly overvalued. Significantly. It's in red. I've been telling people for a long time that the stock market is overvalued. And I was extrapolating that, one, because of how quickly it's going up, but just look at the speculation in the market. Donald Trump said something and the market shoots up. But now here is proof, economic indicator proof of that. We have a serious bubble in the stock market. And a lot of times when you have a serious bubble in the stock market, people have this wealth rich effect in their minds and they spend more money. And as you know, the housing market is booming as well, and the prices of houses are very high. And because of the demand, the prices are increasing, and they're building more houses to compensate for the demand. It's 2007, 2008 all over again, but worse. And the scariest part about it is, this is just my opinion, Donald Trump is our president. Does he have the wherewithal to deal with a major economic crisis on the horizon, probably worse than the one that President Obama faced when he came into office? That's all I want to say about this at this time. I hope that you guys got something out of this. I hope that you can see what's coming, and I hope that you are able to do some type of preparation for what is about to come. At least you have an expectation, which in and of itself may help you prepare, at least mentally. I thank you guys for watching. God bless. Peace.